Many small business owners use their personal credit to run their companies, especially in the early stages. At first, this may feel normal. You might use a personal credit card to buy inventory, pay for software, or handle unexpected expenses, but over time, this approach creates a serious limitation. When your business relies on personal credit, your growth is tied to your personal financial profile. This means your personal credit score, personal income, and personal debt levels control how much capital your business can access. That is where business credit becomes extremely important. Business credit is a financial identity that belongs to your company, not to you as an individual. It allows lenders, banks, suppliers, and financial institutions to evaluate the financial reliability of your business separately from your personal finances. When a business builds strong credit, it can qualify for credit cards, vendor financing, equipment loans, and lines of credit without relying entirely on the owner's personal guarantees. Think of business credit as a reputation system for companies. Just like individuals build personal credit history by paying loans and credit cards on time, businesses build credit history by paying vendors, lenders, and service providers consistently and responsibly. Over time, this payment history becomes a record that shows whether your company is financially reliable. For small business owners who want to grow, hire employees, invest in equipment, or expand operations, business credit can become one of the most powerful financial tools available. It helps separate personal risk from business risk while opening the door to larger funding opportunities. To understand how business credit actually works, it helps to look at the systems behind it. Just like individuals have personal credit reports, businesses also have credit profiles that track financial behavior. These profiles are maintained by commercial credit reporting agencies that collect information about how companies manage their financial obligations. When your business pays suppliers, lenders, and service providers, those payments can be recorded and used to build your company's credit history. A strong business credit profile is usually built through consistent and responsible payment behavior. When a company pays invoices on time or even earlier than the due date, it signals financial stability. Late payments, on the other hand, create a negative record that lenders may see when evaluating the company for financing. Over time, these payment patterns help generate a business credit score, which gives lenders a quick way to assess the financial reliability of a company. One important difference between personal credit and business credit is that business credit often focuses heavily on vendor relationships. Many companies begin building credit by working with suppliers that allow purchases on short payment terms. For example, a supplier may allow a business to receive products now and pay the invoice later. When those payments are made consistently, the supplier may report the positive payment behavior to credit agencies. As more vendors, lenders, and financial partners report payment activity, the business credit profile becomes stronger and more detailed. This growing financial record helps the company gain access to better credit limits, more favorable financing terms, and additional funding options that support long-term growth. Building business credit usually begins with creating a clear legal and financial identity for your company. Lenders and credit reporting agencies must be able to recognize your business as a separate entity from you personally. This starts with forming a registered business structure, such as a limited liability company or corporation. Once the business is legally established, the next step is obtaining a federal employer identification number from the tax authority. This number functions like a financial identification for the business and allows banks and lenders to track the company's financial activity separately from the owner's personal records. After the business is properly registered, opening a dedicated business bank account becomes essential. All revenue, expenses, and financial transactions should flow through this account rather than through personal accounts. This separation helps create a clean financial history for the company and signals professionalism when lenders review your business. Banks and financial institutions want to see that the business operates with its own financial systems and records. The next step is often establishing relationships with vendors that offer payment terms. Many suppliers allow businesses to purchase materials, office supplies, software subscriptions, or inventory with the agreement that payment will be made later. These vendor accounts can become the first building blocks of a company's credit history when payments are made consistently and on time. As the business continues to operate responsibly, it can gradually qualify for additional financial tools such as business credit cards and small lines of credit. Each responsible payment strengthens the company's financial reputation and moves the business closer to larger funding opportunities that support expansion. Once a business begins building credit, the next important step is learning how to manage it responsibly. Business credit is not just about gaining access to money. It is about demonstrating financial discipline over time. Lenders and financial partners want to see that a company can borrow and repay funds without creating unnecessary risk. This means using credit strategically rather than emotionally. One practical approach is to treat business credit as a financial tool for growth, not as emergency money. For example, a business might use a credit line to purchase inventory before a busy sales season, or to invest in equipment that improves productivity. When credit is used for activities that generate revenue, it becomes easier for the company to repay the balance and strengthen its financial profile. Payment timing also plays a critical role in maintaining strong business credit. Paying invoices before the due date shows reliability and financial control. Many lenders and vendors look closely at payment behavior when deciding whether to extend additional credit. Even small delays can affect how lenders view a company's financial habits. Consistent early payments help build trust and create a positive financial record. Another important practice is monitoring how much credit the business is using compared to the amount available. When a company regularly uses only a portion of its available credit, it signals stability and good financial planning. Businesses that rely too heavily on their credit limits may appear financially stressed. By managing credit carefully and using it for productive investments, a business gradually builds a reputation for reliability that opens the door to larger financing opportunities. As your business credit profile becomes stronger, the long-term benefits begin to appear. One of the biggest advantages is easier access to financing. Banks and lenders feel more confident working with businesses that have a clear history of responsible financial behavior. Instead of evaluating only the owner's personal credit score, lenders can review the company's payment history, financial stability, and credit relationships. This separation allows the business to qualify for larger credit limits and more flexible funding options. Strong business credit can also improve the way suppliers and partners view your company. Vendors may offer longer payment terms, larger order limits, or better pricing because they trust that your business pays reliably. These improved relationships can strengthen your cash flow and give your company more operational flexibility. Instead of paying for everything immediately, the business can manage payments strategically while continuing to grow. Another major advantage is protecting the owner's personal finances. When a business relies completely on personal credit, the owner carries all the financial risk. Business credit helps shift that risk toward the company itself. This separation becomes extremely important as the business expands, hires employees, signs larger contracts, or invests in equipment. Over time, strong business credit becomes a financial asset. It represents trust, discipline, and financial maturity. Small business owners who understand this concept early can create powerful opportunities for growth. Instead of struggling for capital each time they want to expand, they build a financial system where funding becomes easier, faster, and more predictable.